Record. Yeah, we are recording it. So good evening again. And let's start. Risk management and trading plan. The idea is very simple. We have to have a plan so we can be profitable in the long run, not only in one trade or one lucky shot that we get once in a while. So this is a nice quote that I like, that it says, in this business, if you're good, you are right 6 out of 10 times. You're never gonna be right 9 out of 10. So what that means is that we don't need to be right to be profitable. Even with 20%, 2 out of 10 times, if you have a good risk reward ratio, you can be at least break even or profitable. So the idea is to focus a little bit more in the quality of trades and the quality of the way we approach our trades, more than the number of trades that we're going to be doing every day. So, and we're going to start with a very simple foundation that we'll have to be having, right? All of us have different size accounts, but regardless of the size, the methodology that we're going to follow is always going to be the same. We just have to adapt or make the numbers work for each size. So here is a very simple table of where we're going to be following. And of course, your account can be over $10,000, and more or less we're going to follow certain parameters that I'm going to give you if your account is above that. But most of us, sometimes we have a 10,000 or less account, and we're looking for our first goal is to get to 25K, so we don't have the problem with the intraday pattern or that kind of issues that we face every day. So let's assume that we have an account size between $500 and $10,000, and I put here some examples that we're gonna be following. But for the sake of this sample, let's do it, I don't know, 3,000 in the middle. So if we have a 3,000 account, our maximum position size is going to be $450, regardless of the number of contracts that they are there, right? I mean, if a contract is 4.5, so we only can buy one contract. If a contract is $1, you can buy 4 contracts, and the 50 cents or rounded to 500, 5 contracts, and so on. But the important thing is that we're going to look for a $250 reward. So that means that even though we place a $450 play, that doesn't mean that we're going to look for the 100% of that 450, because we're not willing to risk all that amount. What are willing to risk with $450 is $75. And because we're going to risk $75 and we're looking for 3-to-1 ratio of risk reward, 75 times 3 is 250, right? Or less. So that is the idea. The only idea is that we place more amount of what we're looking for, is because the larger the amount, the less return that we need in order to accomplish the goal that we're looking for, right? So in this case, 75 times 3 is 225, but okay, well, it's a round number. So far, are we on the same page, right? Everybody's understanding that very simple sample. In the next one here, we have the same table that I showed you before. And for those who have more than 10,000 or are in between these numbers and everything, is very simple. Maximum position per play is the equivalent of 15% of your total account. Okay, for $10,000, 15% is 1,500. And the maximum risk per position is going to be 2.5% of your total account. So this risk that is here in the red column is the equivalent of 2.5% of the account size. So those are always remain like written in stone. Always, always, always you have to follow. Yes, you can do more. Yes, you can do whatever you want. But if you want to be profitable in this business in the long run, you have to obey to these rules. The only way to be able to play bigger sizes is just growing your account. So that 15%, it's bigger when your account is bigger, not before. And another important, very important point here is that we have to set our daily and weekly goals. In other words, if we have a $3,000 account and we're gonna do $250 average of profit per trade, we have to define how many trades we're willing to do or are able to do with our account size and what is the achievable goal that we can have with that. So for example, in a $3,000 account, you can be able to play around 6 trades if you do 450. So 6 trades is the equivalent, and you end up finishing your $3,000 in each assuming that you have a cash account and you settle your your all the money that you sell, you settle the next day, right? But I don't suggest you to make more trades that the ones that can be done dividing your max positions over your account size. So in this case, 5,000 over 500 over divided by 3,000 is 6. So do not do more than 6 trades per day. And in that regards, you can do very easy. Okay, I'm going to do 6 trades and with a 50-50% that you can be right or wrong. Okay, so 3 times you win 450, 3 times you lose 75. You just deduct one to the other, and that could be a very achievable daily goal that you can place. So in this case, I don't know. I mean, my daily goal is going to be $600. Okay, so $600 it is, and when I get to $600, no matter what is happening in the market, no matter what Alfonso is playing or others playing, you just stop trading for that day. Same for the weekly. Not all the days you can achieve. Some days you might lose or do less or that. Okay, but okay, I'm gonna do $600 a day times 5, 3,000 a week. I got to the 3,000 on Tuesday. See you next week. As simple as that. It sounds very difficult to follow, but the market is always going to be there. There's always going to be a next day. The only thing that we have just to strive every day is live another day with some money for the next day. Yeah? So far, are we clear on this very important 5 bullets or points or rules or whatever you want to call it? Okay, how do we gonna execute this? Because this we already know the foundations, we already know our reality, our account size, we know how much we're gonna play maximum per position. We already know where we risk and where reward we're looking for. And how are we gonna translate this to? So I have this table that I have here, and I did the sample with, I don't know, I mean, I did 5,000 here. That doesn't matter, but the idea is, yes, $5,000. account. So maximum play, $750 per play or per position. Looking for a risk of 125 and a reward of 375, right? 3-1, or 3-1. This two this 125 is equivalent of 2.5% of your 5% of your 5,000. The 750 is 15%, as I said, of the total account. And this table is just very simple. It's telling, for example, if we have a contract that is 25 cents, so the maximum contracts that we are able to buy are 30. We're gonna scale it in eighths, so 1/4. So our starter is gonna be 8, and we're gonna be adding 8 contracts if we're gonna go half, 3/4, or full size, right? And once we are in our, when we have an starter, in this case, 8 contracts of 25 cents, our stop is not gonna be the $75, right? Because that is going to be the $75. I mean, it's not going to be the $125. It's going to be less than that because we only have 1/4. So a very easy way to determine what is going to be your stop when you are 1/4 or 1/2 is going to be 50% of that. So in this case, it's going to be, if we start with 200, like 1/4, our stop on that 1/4 or 1/2 is going to be $100, not 125. Once we get to full size, and I'll explain a little bit later when I get to full size or 3/4 or whatever. These two columns, what it tells you is that of 25 cents per contract, my full stop loss is going to be at 25 cents minus 4 cents. So you're going to place your stop at 21 cents. And you need 13 cents to achieve your 375. So that means that 25 cents plus 13 cents, 38 cents. When the contract gets to 38 cents, if you sell them 30 contracts, you're going to make your $375, right? The idea of having a 1-to-3 risk reward ratio, this doesn't mean that on every trade we're going to make $375. That means that the trade that we're taking has the range accordingly to the delta of the contracts to get to $375 of profit. And how do we determine that? It's very simple. I mean, all the plays that I give you and that we're looking for, we look for a underline that it has its next resistance, or that has the enough range because it has been before in that price level, or the next resistance or support is within that range that is going to give us that risk reward. If we don't have that range, we're not going to play it. And that is the reason why so many times I tell you, I mean, don't get in until we get over the 50 MA, right? Because why? Because if we get right away, our next resistance is going to be the 50 MA, and from the price where it is right now to the 50 MA, there's not enough room to accomplish the risk reward ratio, right? And so that is the idea, to wait for the next level to jump, because now it's going to give us the range to achieve our 3-to-1 ratio of risk reward. Any questions in this table? And this table is the same. I mean, this just the difference is 25 cents or $1 or $12 contracts. And of course, if you have $750 per play, you only can play until here, right? Because, and what it says here, $1, that's it. You only can buy one contract of $750. So next steps here. Okay, no, I've messed up. Let me take this off because I didn't wanna do this. And slideshow, I wanted to reduce the here. So next step here is gonna be, okay, how am I gonna determine my entries, where I'm gonna add, and when I'm gonna exit, right? Each trade. Now that I already know what is the amount that I'm gonna be playing and what is gonna be my risk reward, and that's it. So a very simple checklist is, okay, our entries is, we have to check number one, if the setup is present. What I mean with the setup, if it's present or not, is, do we have enough range? The price is in a position that at the next resistance or support is within the risk reward range that we need to accomplish our goal. Secondly, here, risk reward is okay. Okay, so it makes sense. How's the market overall? Are we playing a underline that is very delta, really? I mean, very beta weighted with the S&Ps, the Nasdaq, Russell? How's the market is behaving in that regards? If it's with us or against us? So if we check, okay, we get in. Where we at after 5 or 10 minutes after we put our started, if the trend is holding, if the volume is increasing on the underline under the 10-minute chart, and if our PNL is green already, we are good to go to add our position, to go to 1/2, 3/4, full size. All depends of the situation, right? I mean, it's how to really to determine this the experience and the type of day that you're facing every day is gonna tell you if you're gonna go full size or not. If it's a choppy day like today and last week's, you're gonna be half, 3/4 at most. It's very complicated to be full size because you know that the stock is gonna be up and down, so you're not. It's much safer to go with smaller size, no? If it's a trend day that it's been up since the morning and all day, and the market is very strong, now it's easier to get in. And we've been in that type of markets a lot lately as well, right? I mean, and it's very well too, and very easy to determine if we're in a choppy or a trend day. And a trend day is high volatility. There is no choppy on the S&Ps. It's not within a certain channel or range. Most of the AD line, most of the S&P 500 are in one side, or positive or negative, which is the breadth of the market. So a lot of internals give you the information to know if we're in a trending or a range trending market. So that is what are gonna determine most of the time if we're gonna be playing full size or half size or in between, right? And now the exit. The exit is very important as well. And it's, I believe there are only four ways to exit. Is one is if the target has been met, we exit. If the if the play is already paid and we already achieved the target and we still have one contract or two, we can leave the runner. Always, as I explained you, I mean, once you get profitable, you just move your stops to entry price, or if it's still grinding, a little bit more than entry price. But the idea is to be risk safe as soon as possible. Another way to exit is, okay, the trend has been broken. We have this, you have seen many times that I chart in the chart that I draw the trend line. And if it breaks, 90% of the times that a trend breaks, the price is going to reverse. So that's another, we don't have to wait for our stop to hit to exit a trade that we already know that is going to start changing direction, right? So it's something that we haven't done much. At least I do it often, but uh, I think that I'm going to have to start letting you know that the trend has been broken, so everybody has the opportunity to exit before even waiting for the a stop to hit, right? Or at least you can exit most of your trade if you want to still have some skin in the game. I mean, okay, you exit 80% of your position because the trend has been broken, and you leave something to see what's happened. But most of the time, if the trend is broken, at least for the next minutes, hours, uh, the the trade is not gonna work as used to be when the trend was not broken. Same, instead of the trend, our support or resistance levels, right? Sometimes we're not following a trend. We're following more a support and resistance level, more when it's a choppy market that a certain underline is going sideways. So what we look is for support and resistance levels instead of trends lines, since there's no trend on that day. And the other one, and the last one is the stops loss that we have, right? Is the stop is about to hit? Yes, not. That's the other way to, or the other reason to, so that we have to exit a certain trade. So this is very simple. It looks very simple, these 6 slides. I think that in theory, it's not very complicated to understand this methodology. The hard part is to follow it and be disciplined and get used to it, this type of, because sometimes the bell starts and everything is very quick and you just want to jump in a trade. You don't even look at the chart if it's already breaking the trend or not, or getting a good point when, or in a good level where you're gonna have an edge, and you're not gonna have any trouble, and a lot of stuff that we have to take. And also you have to look in what strike and expiration you're gonna take, right? If it makes sense, this one, or why not this one, or the other one. So that is the idea of being here in this group, that I'm gonna help you out, and that's what I changed also the stream screen today, because I wanna take you along with me to see at the same time seeing the graph of the underline that we're gonna about to take, and also at the same time seeing the option chain and see why we're taking certain strike. A very good way to determine what, in terms of strikes, guys, what is the best, or the strike that makes more sense for when you're getting into a trade is, for example, if you're in you're gonna jump in a underline that is $100, and your target or your next resistance is 110, to say $10 from there. I mean, I know it's wide, but for the sake of an example, take the strike that is in the middle of the way between 100 and 110. In this case, 105. Why? Because you are a little bit out of the money, so the underline is, or the contract is not as expensive as being at the money, but you're in the middle of the way of having a very exponential growth after hitting uh, uh, the midway between the strike price. And because at the end of the day, what we're looking is to be at the money, right? And further but than that, because once we're in the money, the contracts start to move exponentially, right? But a good sign or a good rule is just choose a strike that is between the price of the underline and your target price, or your first resistance level, or it's not exactly your first, but your ultimate goal, right? I mean, I think that is, we're looking for a $5-10 move. Okay, let's go and look for a strike that is in between. And that is a good golden rule that you can use. As it's not always exact, but it's give you a very good sense if you really don't have an idea what to take. I mean, that is a good way to find out which strike you have to take. And of course, when you have a 10,000 or less account, my advice is always very simple: do not play lottos at all. Even though if I call them, only play weeklies on Mondays and Tuesdays, on Wednesday through Fridays. Even Wednesday can be, but definitely Thursdays and Fridays. You don't play same week expiration. You move to the next week or next expiration date. And if you follow those uh, rules, I think, and if you're under $5,000, you don't swing anything unless it's already paid off. So I know that sometimes there's a lot of contract. You might say, Alfonso, but you swing a lot. Okay, yes, but you have to make the calls according to your account size, right? And so always the question is, Alfonso, what are you gonna swing? I'm gonna swing this one, but I have certain reality. And but what I suggest you guys, if you have $5,000 or less, do not swing anything unless it's already paid. If it's a runner and you already have your initial investment out and a little bit of profit, whatever you want with that swing, that's fine. But do not do it if you're not profitable, if you're not 100% profitable of your investment. So I can gladly, if you send me a DM, I can work with you individually on this table here, and even here I can do it customized to your account size and and what are your targets are for the day and in the week, and I can help you out to do that. So send me a DM, and I can work on each of your tables individually. So next is questions. Feel free to jump on mic or in the chat. For me, it's the same, guys, as you wish. You're all of you are allowed to unmute. So, and if you cannot, let me know. But let me know if there's any questions, if there's something that it was not clear, or you wanna see anything else. Are you alive? Anybody? If if you have non-day trades to achieve weekly or monthly goals rather than daily goals, do you do the math for every trade? Yes, I do the math for every trade. It sounds kind of complicated at the beginning, but once you try and you have some experience, you do it automatically. And that is the reason why, if you're starting and you're not acquainted with this, take one trade at as a time. I mean, take your time, take one trade only, jump in when you're ready. I mean, or even paper trade it. I hate paper trading, but at least to train your brain and how to work this risk reward and everything, it's a good way to practice, right? Anton is if you do have non-day trades to achieve weekly or monthly goals rather than daily goals. You can have, I mean, I don't really, I don't, I have more daily goal in terms of profit. I don't know if you have heard me in the past days that I say I'm not, this is a good trade, but I'm not gonna take it because I ran out of bullets, right? I mean, it's, when I say I run out of bullets, is because I already achieved my goal of the day, and so I'm not doing anything else to ruin it or just stop it. Sometimes you don't even have to turn off your computer. I mean, if you are well disciplined enough, I mean, you can continue watching and learning and looking the market and doing whatever here in the chat or whatever. I mean, it's just a matter just to know that for you, your day is done, right? Anything else? Anton, I don't know if I really answer your question because I didn't quite understood what you meant, but if you want to elaborate more or if it has been answered, let me know. Anything else, guys? Okay. I don't know if there's something more. And of course, how do you choose which contract to enter? Again, if you're on a Monday or Tuesday, definitely choose the same week. And the sample that I gave you is in between. The strike is in between the price, the current price, and the target that you're looking for. So if the stock is at $100 and the target is 105, so you look for a 102, 102 and a half strike. Your risk reward is totally messed up, yes, and you have to work on that. And the idea is that regardless of each trade, I mean, I know that it's very complicated to make all your plays the same size because sometimes you don't have same confidence or whatever, but you have to try to do all your plays more or less the same size or at least have the same risk reward, because you can have I don't know, I mean, 3 different plays, and if your maximum position is 1,000, you can have one at 1,000, at the other one at 750, the other one at 500, and that's fine. The difference is that one is at 1/2, the other one is at 3/4, and the other one is full, but the risk reward is going to be the same for the 3 of them. So that is the important thing. So, and we're gonna, do we keep with the trade rules of every month? If you're gonna, at the beginning is no. What we do is, and that's the idea, guys, you keep the same rules, but you just scale up. I mean, if your account is 2,000, once you get to the next level, let's say 3,000, then once you're in 3,000, you move to the table here. So for example, you are right now 2,000. So right now your max position is going to be 350, reward 265. When your account reaches 3,000, you switch to 450 to 5075 and so on. So the idea is that you're upscaling your risk reward amounts accordingly to your account size. What is never is going to change is the 2.5 and the 15% that I mentioned. 15% of your total amount of your total account is the maximum position, and 2.5% of your total account is the maximum risk that you're taking. But the idea is to scale. And it's very complicated to scale every $100, right? So what I do is, for example, you follow this chart. Every $1,000 or every 5,000. I mean, all depends of the size of your account, but set some different levels and just stick with them until you reach the next account size balance, right? Any other question? And of course, we're gonna, now that we're all on the same page with this workshop, tomorrow is gonna make more sense, and we're gonna be discussing this on every trade, right? I mean, and I'll explain you why we took it, why we took that strike, certain strike, where our, as always, I mean, this is our next target level, so that is the reason we took this. But the important thing is that everybody knows where is your stop, so you don't have to be asking me, are you out? Are you? I mean, I'm gonna be out in a different level than you. You just, regardless of where the graph is, if your stop has been hit, you just get out, period. Next trade. So everybody has to be accountable for their own risk reward amount based on the reality of their account size, right? Cannot be the same amount for me than you. I mean, most of you or a lot of you have bigger accounts than me, so that you can even hang a little bit more than me. Of course, for example, Tesla, you have sometimes you have to give in certain stocks like Tesla, you have to give it a little bit more of room because they move in a different range, right? So if the maximum risk has been reached on certain play, but you are not fully sizing, it's very practical to cause yes, I mean, this average down, and you and I have broken a lot of rules with you guys because I never average down on any options. The average down strategy is very good when you're an investor and you have long-term for stocks that don't decay. With options, it's a different story. If you scale down on an option, you are just betting on a lower percentage of, how can I say you, if for example, when you start trade, you have 40% of chances of being at the money, and you scale and you average down in a lower level, you are just putting more money in a lower probability. So you putting the same amount of your first trade, but with less probability of happening. So it doesn't make sense. And that is the idea why I don't really scale that. What I do is I add on my winning positions. That is different. And when you add, your cost is going to be the opposite. Your cost is going to increase because you're going to buy the second batch of contracts more expensive than the first ones that you bought. So we have to get out of our minds that idea of, do we average down? Do we average down? No, we're gonna add on good points or good levels when it gives us a good edge, but only if we are already profitable on the trade, but we're not gonna average down. We're gonna add on our position because the position is working. That is totally different. So we have to start. And I don't know, in this community, I have heard a lot. Are you gonna average down? I mean, come average down in just YouTube and look for average down in the options and really see what is the math behind it, and you're gonna say, what the hell am I doing this? I mean, you're speeding up and waiting for the speed to come down to your face in that regards. So we have to change a lot of things, guys, but we're on time. I mean, we're gonna be fine. That's the idea. But I need you all to have to be on the same page with me, so we don't have to be repeating these very basic foundations that I just explained today, and then we can move to the next stage, which is trying to maximize our risk rewards, right? And don't never be afraid of making your cost basis higher, because that means that is working. What you add in a trade that is not working, you add on a trade that is working. See it that way. I mean, if you have a business that is making profit and you have another business that is not making profit, in which business you're going to invest more capital to growth? In the one that is making money, right? Well, are you going to invest more in the one that is not making? So that is the sense that you have to, that is the way that you have to think about options as well. If you're new in options, no, it's not overwhelming. It's challenging, but it's not overwhelming, because it's gonna develop your brain quicker, and the only difference is that you just have to be in a different speed. I mean, you cannot take all the trades. I mean, just one by one. But don't be afraid of. uh, yes, it's a little bit crazy if you have a lot of positions, but I can assure you, if you only focus in one and only one, and instead of having 4 or 5 trades at the same time, just have one with a little bit more of capital instead of 5 with little capital. It's not going to be overwhelmed. I mean, you just have to focus in one, and you're going to start, once you develop, you're going to start developing muscle memory, to say it in a certain way. But you have to start with the one and finish the process with the one contract on. And I don't mean one contract, one play. How many years have you been doing options full time as a full-time trader? 1 year and a half. Since the first time that I did an up, like 7 years. But this good, no more than 1.5 years. Yes, of course. Only month for you, that's fine. But that is why I'm a moderator, and you are following me. You cannot be I mean, you'll be like me in 1 year. I assure you, you're stick with me 1 year in this group, you're gonna be like me in 1 year or less. But you have to be patient. And I'm 50 years old, guy. You should be 20 or 25. So give it a time, okay? So relax. Every time, everybody has its own time. You also have to be patient in that regards. I mean, you're telling me like if you were like 90 years old and you're gonna about to die in 2 years. I mean, give me a break. Be patient. There's a lot of time to develop your skills. So just stick to it. Don't be looking for different strategies and I mean, you have to stick with something at least 3, 4, 5 months. If you're jumping from one to another, you're never gonna master anything. So, and that's the reason that we're here, to help each other. I mean, this room is very open. You all of you have access to voice, so you can jump in for any question that you might have. If there's not enough time or the market is a lot of turmoil at that moment, we always can have a talk after market hours. So I'm always available, guys. So don't you worry. I'm using my EMAs are the same for the 3 time frames, 4, 8, 13, and 50. All the 10-minute, the hour, and hourly, and the daily have the same time frame, the same EMAs. Okay, guys, I think that if you don't have any other questions, and if you have you have another question later on, or shoot me a DM or put the question in the room, we'll answer it. And hopefully tomorrow we have another exciting day, a little bit more exciting than today, but I think that it's gonna be an interesting week. All right, so thank you. Gonna have to DM you because my poor group. Perfect. Nice to hear. You're welcome, guys. So see you tomorrow. Don't miss it tomorrow, and let's make some money this week. Take care.